The gold mining industry does not have one entry point. It has four, and they do not share a zip code in terms of price. At the bottom of the table, you stake a mineral claim on Crown land in Canada, the most active gold exploration jurisdiction on the planet, for $50 to $500 per hectare, depending on the province. You obtain a prospector's license, and you hire a drill crew to start punching holes in ground where you believe gold exists. Phase 1 drilling costs $3 million to $8 million. If the holes return something that looks like a real deposit, Phase 2 costs another $5 to $15 million for more density drilling and metallurgical testing. Then you commission a preliminary economic assessment. By the time you have a document that says, on paper, that a mine is viable, you have spent $40 to $80 million over 5 to 8 years. You have not yet applied for a single operating permit. The capital required to take a grassroots discovery all the way to a small producing mine, call it 20,000 ounces of gold per year, runs $90 million or more in initial capital expenditure alone. That figure excludes the exploration capital you already spent. It excludes 10 years of salary for yourself and your team. It excludes the wells that came back dry. At this tier, you are not buying an asset. You are financing a hypothesis. One tier up, you skip the exploration phase entirely and acquire a small to mid-producing mine from a junior company that ran out of money or patience. These assets trade between $100 million and $400 million depending on reserve quality, ore grade, mine life, and what jurisdiction they sit in. You are buying operational certainty, power infrastructure, haul roads, a permitted processing plant, an existing workforce at a discount to replacement cost. The unknown is usually that the mine has a problem the seller has not fully disclosed, and you will discover it during your first wet season. The middle tier of the market is a single clean transaction. In March 2025, Orla Mining paid Newmont Corporation $850 million USD for the Musselwhite gold mine in northern Ontario. Musselwhite is an underground mine that has produced close to 6 million ounces of gold since the 1990s and was targeting 180,000 ounces per year under Orla's ownership. That is a publicly filed deal with a disclosed price and a named buyer and seller. It is the reference point for what a serious producing mid-tier gold mine costs when a motivated seller meets a well-capitalized buyer. At the top of the market, you are buying companies, not mines. In December 2024, Northern Star Resources, a major Australian gold producer, acquired De Grey Mining for $3.26 billion USD. De Grey's Hemi deposit in Western Australia is one of the largest undeveloped gold resources discovered in the past decade. That same year, AngloGold Ashanti paid approximately $2.5 billion for Centamin plc, taking control of the Sukari mine in Egypt, a single asset producing over 400,000 ounces per year. At this level, you are not acquiring a piece of geology. You are acquiring a sovereign industrial relationship with a national government, a unionized workforce, and a political exposure profile that requires its own risk team. The price you pay signals something important. The cheaper the entry, the more unknown you are purchasing. The more you spend, the more someone else has already converted uncertainty into data, and you are paying a premium for that conversion. Here's the number that will wreck your pro forma: 15.7 years. That is the average time from initial discovery to first commercial production, calculated across 127 mines that came online globally since 2002, according to analysis by S&P Global Market Intelligence. Nearly 12 of those years are spent in the pre-production phase: exploration, resource definition, environmental baseline studies, feasibility work, and permit applications. On paper, 12 years looks like a lot of steps. In practice, it is mostly waiting. In the United States, a new mine on federal land requires a mining plan of operations approved by the Bureau of Land Management before any ground disturbance exceeding 5 acres. The BLM's average review time for a full mining plan was approximately 79 months as of 2024. That is 6.5 years for one agency before you obtain the other 15 federal and state permits you still need. In Canada, the framework looks different, but the timelines are similar. Both the Federal Impact Assessment Agency, under the Impact Assessment Act, and the relevant provincial authority must sign off on major new mines. In jurisdictions like British Columbia or the Yukon, the Crown's duty to consult with affected Indigenous nations under Section 35 of the Constitution Act creates legally enforceable obligations that cannot be waived, cannot be bought off, and cannot be shortcut. Projects that inadequately consult have been stopped by court order after construction has already begun. The Yukon's Eagle Gold Mine, one of the most prominent recent gold developments in the territory, generated licensing documents that fill an entire section of the Yukon government's website. The permitting costs for a large new mine are not trivial: $10 million to $30 million in government fees, third-party environmental studies, hydrogeological modeling, socioeconomic impact assessments, and the legal team you retain to navigate the procedural record. This is before a gram of ore is moved. The practical consequence of this timeline is a specific and underappreciated economic problem. Every dollar you spend in year one on exploration will not generate revenue for 15 years. At a 10% cost of capital, a dollar spent today is worth 23 cents by the time you see cash from production. Almost nothing else you can legally do with capital destroys present value as thoroughly as greenfield mine development. There is a faster route into this business, and it does not require owning the mine. The gold royalty and streaming model lets you write a single check today in exchange for a perpetual contractual right to purchase a fixed percentage of a mine's future gold production at a predetermined price, sometimes as low as $400 per ounce, regardless of what the spot market does. You participate in the upside, you collect on the cash flow, and you carry none of the operational liability. No workers, no permits, no heap leach pads, just a revenue stream written into a contract. The royalty market for producing mines starts at around $5 million. For that, you might acquire a net smelter return royalty, typically 1% to 3% of metal revenues from a specific mine, on an asset that is already generating cash. You are now the bank that financed the builder, and you collect rent in perpetuity. In May 2025, Gold Fields launched a $2.39 billion bid to acquire Gold Road Resources, the co-owner of the Gruyere mine in Western Australia. What Gold Fields was purchasing in part was a structural position where ownership of a royalty interest in a high-grade producing joint venture provided better risk-adjusted returns than running the full operational entity independently. Gold Fields specifically cited the royalty and streaming structure as a value driver in the acquisition thesis. The deal was driven by a recognition that in a period of high gold prices and escalating operating costs, the cleanest position in the gold industry is not to be the operator, it is to be the counterparty to the operator. The streaming and royalty play is the argument that the smartest entry into this business is to be the lender at the bottom of the capital stack, not the person running the machine at the top. Naturally read transition. Leave blank, strip away the geology and the permits and the corporate structure, and here is what a gold mine actually is. A factory that converts rock into cash, and its only real variable is the spread between what the rock costs to process and what the metal inside it sells for. The analogy that makes this concrete: it is a vending machine. The machine eats ore. It runs that ore through crushing, grinding, and a leaching process using a dilute cyanide solution that chemically separates gold from the surrounding rock, then recovers the gold through electrowinning and smelting. The machine has a cost per ounce of gold it produces. The spot market tells you what each ounce is worth. The spread between those two numbers is your business. At a small mine producing 0 ounces per year with an all-in sustaining cost of $800 per ounce, your machine costs $36 million per year to run. At today's spot gold price of approximately $4,068 per ounce, your annual revenue is $81.4 million. Your gross mine margin before taxes and corporate overhead is $45. $4 million on $36 million in costs. That is a 126% return on operating expenses at current gold prices. Scale that to institutional size. In 2026, Orla Mining's Musselwhite target is 230, zeroes in to 240,000 ounces per year. At the same math, gold in $68 and an AISC near $600 per ounce at a well-run underground operation. The gross mine margin on 235, 0 ounces per year, is approximately $575 million on a single mine. That Orla paid $850 million for this asset is increasingly looking like a deal that pays itself back in under 2 years. The critical number to internalize is the AI's all-in sustaining cost. It is not the same as the simple cash cost. ISC includes everything required to keep a mine running indefinitely: direct mining and processing, site administration, sustaining capital to replace worn equipment and maintain infrastructure, royalties paid to host governments and landowners, and mine-level exploration to replace reserves as you deplete them. The global industry median sits at $1,580 to $1,650 per ounce as of mid-2026. At today's spot price of $4,068, down from the January 2026 all-time high of $5.89, but still more than double the 2020 average. The median gold miner is generating roughly $2,400 per ounce in gross margin before income taxes and corporate level overhead. That margin, applied across a diversified portfolio of producing mines, is why total gold mining M&A in 2024 reached $26.54 billion and has not slowed down since. In March 1993, a small Alberta-based company called Bre-X Minerals Limited purchased exploration rights at a site called Busong in the rainforest of East Kalimantan, Indonesia. The company was run by a Calgary promoter named David Walsh, who had a declared personal bankruptcy and a history of failed ventures. What Bre-X announced over the following years was the largest gold discovery in history. A deposit at Busong that geologists estimated contained 70 million ounces of gold, roughly double what the entire North American continent had produced up to that point in time. The stock, which had traded at pennies, rose to CAD $286.50 per share on a split-adjusted basis by May 1996. The company's market capitalization reached CAD $6 billion. The Ontario Teachers' Pension Plan bought in. Lehman Brothers recommended it. The Indonesian government was negotiating development rights. Freeport-McMoRan, one of the largest mining companies in the world, agreed to become a joint venture partner. The deposit did not exist. Bre-X's chief geologist, a Filipino national named Michael de Guzman, had been systematically salting the drill core samples. Over 2.5 years, he purchased an estimated $61,000 worth of panned alluvial gold from local Indonesian suppliers and mixed it into the core samples before they were tested and certified. The gold was real. The Busong deposit was not. It was the most elegant fraud the mining industry had ever seen, because you could not detect it without physically controlling the sample chain of custody in a remote Indonesian jungle. In early 1997, Freeport-McMoRan's own independent drilling returned essentially zero gold. Freeport's internal results leaked in March 1997. On March 19, 1997, Michael de Guzman fell from a helicopter while traveling to the Busong site for a meeting with Freeport's team. A body was found in the jungle 4 days later. It was partially consumed by animals. The hands and feet had been surgically removed. The face was unrecognizable. No DNA testing was conducted before the body was cremated. Whether Michael de Guzman died in that jungle has never been definitively established. David Walsh fled to the Bahamas. He cooperated with investigators and denied knowledge of the fraud. He died of a brain aneurysm in June 1998. John Felderhoff, the chief geologist who oversaw the Busong operation and sold $84 million worth of Bre-X stock in the months before the collapse, was tried on 8 counts of insider trading in Ontario, the only criminal proceeding ever initiated in connection with the largest mining fraud in history. He was acquitted on all counts in 2007. 40,000 investors lost their complete investment. Total losses exceeded CAD $6 billion. Nobody served a day in prison for any of it. The specific failure mode here is this: the mine never existed. You were buying a geological fiction, certified by experts who trusted a chain of custody that was being manipulated at the source. The auditors did not physically test the core. The independent verifiers relied on the company's sample handling. The lesson is not about Indonesia or penny stocks or the 1990s. The lesson is that in any resource-based investment, the physical verification of the underlying asset is the only verification that counts. Everything else is a document. This one is different. The mine was real. The gold was real. 9 people died anyway. On February 13, 2024, the heap leach pad at the Shepler gold mine in Erzincan province, eastern Turkey, failed catastrophically. A heap leach pad is essentially a mountain of crushed ore. In Shepler's case, saturated with a cyanide solution that sits on a lined pad while the solution percolates through and leaches the gold out for collection. When the Shepler pad failed, approximately 10 million cubic meters of material collapsed and slid toward a creek below the mine site. 9 workers were buried. The last body was not recovered until June 2024. Shepler was 80% owned by SSR Mining Inc., a Canadian company headquartered in Denver, Colorado. SSR had acquired the mine through its 2020 merger with Alacer Gold Corp. Shepler was SSR's flagship asset, its single largest producing mine, contributing the majority of the company's annual revenue. Turkish authorities revoked SSR's environmental permits within days. A 262-page expert report commissioned in the aftermath concluded that 13 mine officials bore primary negligence for the collapse, and 26 bore secondary negligence. 12 people were eventually arrested, including Canadian personnel associated with the operation. By the most recent reporting, SSR had spent $149.3 million on reclamation and remediation at the site. That is money spent cleaning up a mine that is no longer producing. In U.S. federal court in Colorado, a class action securities fraud lawsuit was filed, Karam Akras v. SSR Mining Inc. et al. The complaint alleges that SSR's executives, including President and CEO Rodney P. Antal, made materially false and misleading statements about Shepler's safety systems and regulatory compliance, statements that investors relied on when purchasing SSR stock, and which allegedly inflated the share price before the collapse destroyed it. SSR stock fell more than 70% in the weeks following the incident. Antal was named as a defendant. The failure mode here is structurally opposite to Bre-X. The asset was real, permitted, producing, and generating cash. What failed was the engineering containment of the physical process, and the company's alleged willingness to represent that process as compliant when a 262-page expert report would later characterize it otherwise. 9 workers are dead. The Turkish trial is ongoing. No one in the executive chain has been convicted. The Shepler collapse is the version of this business where everything you were told about the mine is true. The reserves, the grades, the permits, the production guidance. And you lose it all in a single afternoon because the ground gave way. There are 4 rules that both of these cases point at directly. Rule 1, verify the physical asset independently before you commit capital. Not the reports, not the certifications. Not the independent technical review that the company commissioned and published. You hire your own team, they go to the site, and they control the sample chain from extraction to analysis. Bre-X was undetectable until Freeport ran its own drill program. The only defense against that failure mode is the same defense: your own drill program, your own geologists, your own laboratory. Rule 2. Heap leach pads and tailing storage facilities are your largest unquantified liability. They are the cheapest way to process low-grade ore and the highest consequence failure mode in the industry. Before acquiring any asset that uses heap leaching, you need an independent geotechnical stability analysis, not a review of the permit, not a reading of the last annual report. A geotechnical engineer on site, reviewing the liner integrity, the drainage design, and the slope angle before the deal closes. Rule 3. The operating permit is not a property right. SSR Mining had valid environmental permits in Turkey for years. They were revoked within 72 hours of the collapse. Your mine can be legal, profitable and fully permitted on a Tuesday, and shuttered with remediation costs accruing by Thursday. Jurisdiction selection is not a secondary consideration. It is the primary consideration. Rule 4. The regulator is a counterparty, not a partner. Every regulatory body that approves your operation retains the right to withdraw that approval if conditions change. Design your operation so that a permit revocation is survivable. That means lower debt, higher reserve cushions, and no single mine exposure where one permit the entire company. The single biggest structural threat to this business model is not a gold price decline, though that would hurt. The real threat is time consuming the asset faster than you replace it. Every gold mine has a reserve life, the number of years of production until the economically extractable ore is gone. The global average is approximately 11 years. The large-scale exceptions, Muruntau in Uzbekistan, Grasberg in Indonesia, are maintained by continuous expensive reinvestment in reserve replacement. Your typical producing mine without that reinvestment closes in a decade. The industry benchmark from the World Gold Council shows that global gold miners are currently replacing only approximately 50% of the reserves they deplete annually. They are consuming the asset base at twice the rate they are replenishing it. Global gold mine supply has been essentially flat since 2019. Output reached approximately 3,300 metric tons in 2024, barely above the 2018 peak, despite a gold price that has more than doubled in 5 years and provided capital that should theoretically incentivize aggressive exploration. The explanation is geological, not financial. The easy deposits have been found. The Tier 1 discoveries, the Hemis and the Busangs, are rare. The average grade of gold ore being mined globally has fallen from approximately 8 grams per ton in the 1990s to under 1.1 grams per ton today. You are processing more rock to get the same amount of gold. That is a structural cost escalator that does not reverse. Grand View Research projects the global gold mining market to grow from approximately $260 billion in 2024 to $710 billion by 2033 at an 11% compound annual growth rate. That projection requires elevated gold prices and meaningful new supply to materialize. The industry is currently generating record margins at $4,068 per ounce with median AIC near $600. Margins are wider than at any point in history, while simultaneously consuming the reserve base that produces those margins. The reconciliation between those two facts is the central question the industry cannot answer. Time to pull it all together and answer the actual question: how much money do you actually make if you do this right? Scenario 1. Small producing mine, realistic case. You acquire a small permitted gold mine in a Tier 1 jurisdiction, Northern Ontario, Nevada, Western Australia, for $50 million. It produces 20 zeros and ounces of gold per year and has a demonstrated reserve life of 10 years. You spend $10 million in year 1 on capital improvements to the processing circuit, bringing your total invested capital to $60 million. Revenue at today's gold price of $4,068 per ounce, $81.4 million per year. Your all-in sustaining cost is $1.800 per ounce, conservative for a small underground operation, giving you $36 million in annual operating costs. Gross mine margin, $45.4 million. Subtract $4 million in corporate overhead. Pre-tax income, $41.4 million. At a 25% effective tax rate, roughly what you'd expect in a Canadian jurisdiction, your annual net profit is approximately $31 million. On $60 million invested, that is a 51% annual return. Your payback period is just under 24 months. Over 10 years, assuming gold prices stay in the current range, your cumulative net profit approaches $250 million on a $60 million investment. The risk that kills this scenario is a 30% gold price decline, which would compress your net margin to approximately $8 million per year, stretch your payback to 7.5 years, and make the investment mediocre rather than exceptional. Gold has declined 30% before. It did so between 2011 and 2015. Scenario 2, mid-tier acquisition, the Orla Mining Playbook. You pay $850 million for a producing mid-tier mine, the Musselwhite equivalent. You target 180 ounces per year with a proven reserve supporting over 10 years of production and a credible path to extensions. Revenue at $4,068 per ounce, $732 million per year. AIC $600 per ounce, $288 million. Gross mine margin, $444 million. Corporate overhead, $20 million. Pre-tax income, $424 million. At a 25% effective rate, your annual net profit is approximately $318 million. On $850 million invested, that is a 37% annual return. Payback period, 2.7 years. Over 10 years, cumulative net profit approaches $2.7 billion on an $850 million investment, a 3.2x cash-on-cash multiple. At the price Orla paid and the gold price operating today, Musselwhite may be the best risk-adjusted industrial asset acquisition that closed in 2025. The difference between these two scenarios is not just scale. It is that at $850 million, you bought a mine with 25 years of operational history, existing infrastructure that took decades to build, an experienced workforce, and a resource base that has already been drilled and modeled by multiple independent teams. The $50 million mine is cheaper because the unknowns cost less to acquire. The Musselwhite is expensive because someone already paid for the certainty. So here is where you end up. You came into this thinking the hard part was finding the gold. The hard part turns out to be the 15.7 years of permits, the geotechnical risk you did not model, the jurisdiction you trusted because the government seemed stable, and the regulator who can revoke your permit before you recover your capital. The people who do best in this business at the highest margins are mostly not the people who own the mine. They are the people who wrote the streaming agreement with the people who own the mine. They collect at $400 per ounce, while the mine owner runs the heap leach pad, manages the workforce, and waits to find out if the ground holds. Whether that is the smarter position or just the less interesting one is a question the numbers answer the same way every time, and the answer makes for a less cinematic flannel shirt story. If this is the kind of calculation you want to see on more asset classes, subscribe. This channel runs these numbers on everything where the gap between the fantasy and the balance sheet is large enough to be worth examining.